Welcome back to the Deep Dive. Today, we are staring down a massive question, one that I think plagues every investor who likes a little bit of risk but absolutely hates losing money.
Oh, yeah. It's a classic dilemma.
It's the ultimate tension in the market right now. Can you actually apply strict, conservative, Benjamin Graham style value investing principles, the kind of stuff Warren Buffett grew up on, to a vice industry? An industry defined by regulatory chaos, by speculation, and frankly, by a lot of broken promises.
It is the ultimate tension, isn't it? I mean, usually value investors are looking for boring. They want predictable cash flows.
Right. Toothpaste, insurance.
Exactly. They want toothpaste, they want insurance, they want toilet paper. But today, we are looking at cannabis, craft beer, and global pharmaceutical distribution. It's a very strange mix.
It's a bizarre mix.
Yeah.
And the question we're trying to answer isn't just, is this a good stock? It's much more specific than that. Is this company a value trap, just spiraling down into a black hole of delusion? Or is it a coiled spring, undervalued by something like, 22% and just ready to pop? Because the narrative has been completely all over the place for years.
And to answer that, we have to look at the specific context of where we are right now. We need to ground ourselves in the present. Today is Wednesday, February 18th, 2026.
Right. Let's set the scene. It's early 2026. The world looks a little different than it did a few years ago. We've got, new trade wars, new taxes, and the cannabis sector has just been put through the ringer.
It certainly has. And for our subject today, Tilray Brands ticker TLRY, the landscape has shifted dramatically. As we record this, the stock is trading intraday around $7.80.
Right.
The recent close was $7.51. But that price point exists in a post-restructuring world. I mean, we've seen a massive reverse stock split. We're dealing with major geopolitical shifts like the new tariffs and the company itself. Well, it looks very different than it did during the pot stock boom of 2018 or even the optimism of 2021.
So our mission today is to take the deep research report we have in front of us, which is dated today, February 18th, 2026, and just strip it down. We are not just looking at a weed company. That's the old lens.
That's the key.
We are analyzing a diversified lifestyle CPG conglomerate. We need to look at intrinsic value, we need to look at moats, and for the love of God, we need to look at cash flow.
That is the only way to do it.
Yeah.
You have to ignore the hype, you have to ignore the Reddit threads, and you have to look at the engine under the hood.
Okay, let's unpack this. Part 1, chapters 1 to 3. Business, management, and financials. Chapter 1, business understanding. So, chapter 1, business understanding. I want to start with a confession. I think the biggest misconception, and I'll admit I've been guilty of this even recently, is thinking of Tilray as just that Canadian pot stock. Is that still fair, or am I just, living in 2021?
You are definitely living in the past if you view it that way. I mean, it is absolutely not fair anymore. In fact, if you view it solely as a Canadian cannabis LP, a licensed producer, you are missing half the picture, and arguably the more stable, more interesting half of the picture.
So what has changed?
Over the last 5 years, Tilray has morphed. It has evolved from a Canadian cultivator into what they now call a global lifestyle consumer packaged goods conglomerate.
That sounds like a mouthful of corporate jargon. Lifestyle CPG conglomerate. It sounds like something a consultant came up with to justify a very high fee. What does that actually mean in terms of where the money comes from?
It's a fair criticism, but what it really means is that they realize that waiting for governments to legalize weed is a great way to go broke. It's a terrible business plan.
Just sitting around waiting.
Yeah, just sitting around bleeding cash. So they built a 4-pillar revenue model. It's a diversification strategy, and it's designed to survive the fact that cannabis regulations move at a glacial pace. They simply refuse to sit on their hands while waiting for the U.S. Congress to get its act together.
Okay, so 4 pillars. Let's break them down. Pillar 1 is obviously still cannabis. That's their heritage, right?
Right. And in that pillar, they are the heavyweight, no question. In Canada, they are the market leader in adult use recreational cannabis. They have brands like Good Supply, Broken Coast, Radican.
I've seen those.
If you walk into a dispensary in Toronto or Vancouver today, you are seeing their products everywhere. They have the scale that the smaller players just cannot match.
But the Canadian market is tough, right? I mean, we've all heard the horror stories about price compression, just a race to the bottom.
It is brutal. There's too much supply, too much weed, and not enough buyers, which just crushes prices. But because Tilray is the biggest, they can survive on thinner margins than a mom-and-pop grower can. It's a volume game.
And it's not just Canada, right? This is the part I think people miss.
Exactly. This is the part people miss. They have a massive footprint in Europe, specifically in medical distribution. Their facilities are EU GMP certified.
EU GMP. Now, that's the gold standard, isn't it? Break that down.
It is. It stands for Good Manufacturing Practice, European Union standard. It's pharmaceutical grade. You can't just, grow some plants in a basement and ship them to Germany.
Right.
You need labs, you need clean rooms, you need documentation, you need batch tracking. Tilray has that. So they are moving medical cannabis through Europe, specifically Germany, which is a market that is slowly but steadily opening up.
Okay, so that's pillar one, the legacy business. But pillar two is the one that I think surprises people who haven't paid attention lately, the beverage pillar.
This is the Trojan horse. And I don't use that term lightly. It's the core of their entire U.S. strategy.
I love that description. Why a Trojan horse? Is it because they are sneaking something in?
That's exactly it. Right now, on paper, it looks like they are just selling beer. I mean, over the last few years, they've gone on an absolute shopping spree. They acquired craft brands in the U.S., Sweetwater, Montauk, Shock Top, Breckenridge, Hop Valley.
Big names in there.
Big names. They're actually the fourth largest craft brewer in the United States now.
Fourth largest. That's significant. So they aren't just a niche player anymore. And didn't they buy some of those from Anheuser-Busch when they were shedding assets?
They did. That's a key part of the story. They bought what we call distressed assets. Anheuser-Busch InBev was looking to slim down to get rid of brands that weren't really moving the needle for them on a global scale, but were still household names in the U.S.
So Tilray swooped in?
They swooped in and bought them for, pennies on the dollar compared to what they would have cost 5 or 6 years ago.
But here is my skepticism, and I think it's a valid question. Beer consumption is down. Gen Z isn't drinking like millennials did. Why buy into a shrinking market?
That is the valid bear argument, and we'll touch on that more in the risks. But here's why it's a Trojan horse. They aren't just trying to sell IPAs to boomers. That's not the end game. They are building a massive distribution network.
Okay.
Think about what a beer company actually is physically. It's breweries, yes, but more importantly, it's trucks, it's warehouses, it's relationships with distributors, with liquor stores, grocery chains, gas stations.
I see where you're going. It's all about the pipes. They're buying the plumbing.
They are buying the pipes. Or let's be honest, when the U.S. federal government legalizes cannabis, or more likely reschedules it to Schedule III, Tilray doesn't have to start from scratch.
Right, they don't have to go rent a bunch of U-Hauls.
Exactly. They don't have to build a logistics fleet. They can take those beer trucks, which are already going to the exact same retail locations they need to be in, and just fill them with THC-infused drinks.
That is the aha moment. The beer is the infrastructure waiting for the weed. They are effectively letting the beer business pay for the logistics network that the cannabis business will eventually inherit. It's actually kind of brilliant.
It is. It's a call option on U.S. legalization. They are making money, or at least generating cash flow on beer now, but the real enormous value is the piping they are laying down for the future.
And speaking of beer, we have to talk about the news from today, February 18th, 2026. This is hot off the press.
Yeah, this just broke.
The Carlsberg deal. This seems huge, but explain the mechanics of it to me.
It is a major validation of this whole strategy. Tilray just announced an exclusive licensing deal with the Carlsberg Group.
One of the biggest beer companies in the world.
A giant. Starting in January 2027, so just under a year from now, Tilray will be the exclusive manufacturer and distributor of Carlsberg 1664 and Kronenberg in the United States.
Wow. So if I'm buying a Kronenberg in a bar in New York in 2027, Tilray made it and shipped it.
Precisely. And that elevates them from just being a craft brewer aggregator to a strategic partner with a global legacy brand. It proves their distribution network is real, it's efficient, and it's respected.
Yeah, you don't get that deal if you're a mess.
No. Carlsberg wouldn't trust a chaotic pot stock with their flagship brands. They trust a CPG operator. This is proof of the transformation.
Okay, that's a big deal. So moving to pillar 3, distribution. This is the German piece, right? CC Pharma.
Yes, CC Pharma. It's a medical distribution company in Germany. To be perfectly honest, it's not the sexiest part of the business.
Right, it's not craft beer.
No. It's high revenue, but very, very low margin. It's pure logistics. It's moving pallets of drugs to pharmacies.
So why keep it? If the margins are so bad, why not just sell it?
Because it pays the bills, it keeps the lights on, and most importantly, it keeps the channels open. It gives them a massive, established footprint in the European medical system. If and when Germany fully embraces adult use sales, Tilray already has the relationships with thousands and thousands of pharmacies. They're already in the system.
Its strategic placement is another set of pipes just in Europe. And finally, Pillar 4, wellness.
Manitoba Harvest, this is hemp foods. You've probably seen it at Whole Foods.
Oh yeah, the hemp hearts?
Hemp hearts, granola, hemp milk, all that stuff. They have a 60% market share in North America. It's a stable business. It's in every major grocery store. It targets that health-conscious consumer. It's not going to 10x overnight, but it generates consistent cash.
So you have these 4 pillars: cannabis, alcohol, pharma distribution, and hemp wellness. It's a hedge. It's a full-on diversification play.
It is a survival mechanism. If cannabis regulation stalls for another 5 years, they sell beer and hemp hearts. If cannabis explodes tomorrow, they have all the infrastructure ready to go.
Now, before we leave the business section, we have to talk about the geopolitical landscape of 2026. Because something happened in 2025 that changed everything for cross-border trade. And it specifically and weirdly helps this company.
You're talking about the tariffs.
The tariffs. The U.S. imposed 25% tariffs on goods from Canada and Mexico. Usually for a Canadian domiciled company, that is a death sentence. If you are growing tomatoes in Ontario and shipping them to Detroit, you just lost your entire margin.
Usually, yes. It would be catastrophic. But this is where Tilray's strategy of buying U.S. breweries looks like absolute genius, whether it was intentional 4D chess or just, lucky timing.
So?
Because they acquired physical breweries inside the United States, in Georgia, in New York, in Colorado. They are manufacturing their beer domestically. It never crosses a border.
So let's do the math on this. If I'm a competitor, say, another Canadian LP, and I'm trying to ship a beverage from Smiths Falls, Ontario to New York.
You are getting hit with a 25% tax at the border, period. Your cost of goods sold just skyrocketed. You either have to raise your prices and lose customers, or you have to eat the cost and lose money. There's no good option.
And Tilray's Sweetwater beer, brewed in Atlanta.
Zero. They are immune to the cross-border tax because the product is made in America by American workers in American facilities. Meanwhile, their competitors who are relying on imports are just bleeding out.
That gives Tilray a massive pricing advantage. I mean, a structural one. They can undercut the competition or just enjoy much fatter margins while everyone else suffers.
Huge. In 2026, that is a unique asset that you cannot overlook. They are insulated from this trade war in a way that very, very few Canadian origin companies are. It's a structural moat that was created entirely by geopolitics.
Chapter 2, Management Evaluation. Now, a strategy like that, buying up distressed breweries, maybe inadvertently dodging tariffs, it doesn't just happen by accident. It takes a specific kind of CEO to pull that off. So, Chapter 2, Management Evaluation. Let's talk about the driver, CEO Irwin D. Simon.
Irwin Simon is a fascinating character in this space. He is not a cannabis guy originally. He's not a counterculture figure who loves the plant.
No tie-dye t-shirts in the boardroom.
No, he's a CPG guy through and through.
Yeah.
He built Hanes Celestial, the organic food giant, from basically scratch into a multi-billion-dollar company.
So he knows how to sell packaged goods. He knows the grocery store game. He knows how to get tea bags and, organic chips onto the shelves at Kroger.
He knows how to scale, and critically, he knows how to deal with razor-thin margins. His style is very pragmatic. He's not a dreamer. You listen to him speak on earnings calls, and he's not promising that everyone on Earth will be smoking weed tomorrow. He's a crisis manager. He's a survivalist.
And he's had to be, right? I mean, he took over Afria during a crisis, then merged it with Tilray. He's been putting out fires for years.
Correct. He's been in the trenches. But there is a major critique of his style, and we need to address it honestly, and that is the capital allocation strategy.
You mean the M&A addiction? It feels like every time I look at the news, Tilray's buying somebody else.
It does look like an addiction. Sales have grown 16x since 2019. I mean, that is an explosive number. But almost all of that growth came from buying other companies, merging with Afria, buying the beer brands, buying Hexo. Remember Hexo?
Oh, vaguely. They were the next big thing for about 15 minutes, and then they cratered.
Right, and they imploded. Tilray basically bought them for parts. But this raises the critical question, is this empire building? Are they just buying revenue to make the company look bigger on a chart, or are they actually creating long-term value?
So the critics would say.
The critics would say Irwin is just aggregating a bunch of distressed assets to hide the fact that the core cannabis business is struggling to grow organically.
Basically, you're painting over the cracks with new acquisitions.
Precisely. It's a classic corporate maneuver. If your main business slows down, you just go buy a new business to show growth on the top line, even if your profitability is terrible.
But on the flip side of that, he's cutting costs aggressively, we have to talk about Project 420, which is a hilarious name, by the way.
Yes, Project 420. It sounds like a joke name. I mean, come on.
Yeah.
But it's a very serious cost-saving initiative. They targeted $33 million in savings by integrating all these beverage companies they bought.
And how are they doing on that?
As of the last quarter, Q2 2026, they've already achieved $27 million of that. So they're on track.
So they are executing on the efficiency side. They aren't just buying companies and letting them run wild. They're actually going in and trimming the fat.
They are. And I'll give Simon credit for transparency. Management has been very open about the fact that the Canadian wholesale cannabis market is terrible right now. They came right out and admitted that wholesale is less accretive, which is fancy Wall Street talk for unprofitable, and they voluntarily pulled back from it.
That takes discipline. I mean, a lot of CEOs would chase that revenue just to make the top line look good. To say, we aren't going to chase revenue if it loses us money, that's a good sign.
Exactly. A growth-at-all-costs CEO would keep selling just to show the bigger number. Simon is saying, no, we have to protect our margins. It's the difference between selling a tomato at a farmer's market for $1 versus selling a truckload of tomatoes to a processor for a nickel each. Irwin decided he's tired of the nickel game.
However, and this is a big however, we cannot talk about management without talking about the elephant in the room. The event that happened just a few months ago, December 2nd, 2025.
The reverse stock split.
A 1-for-10 reverse split.
A brutal 1-for-10, meaning if you had 1,000 shares, you woke up the next morning and you had 100 shares. Now, the price was adjusted up by a factor of 10, so you didn't lose money on paper that morning. The value of your holding stayed the same, but your share count was decimated.
And management's justification for this was, what again?
The official line was that it was to save administrative costs. Something like $1 million a year in postage for proxy mailings.
Come on. Nobody believes that.
That was the official line. But let's be real, you don't do a massive, psychologically damaging reverse split just to save $1 million on postage. That's insulting to the intelligence of your investors.
It felt like a slap in the face. I mean, retail investors hate reverse splits. It just feels like theft, even if the math works out.
They despise them. It feels like a reset button that wipes out the history of your share count. But the reality, which the expert side of me has to point out, is that reverse splits are almost always defensive moves. They are often done to ensure you stay compliant with NASDAQ Hugh listing requirements. You have to keep the stock price well above $1 and, more importantly, to mask years of dilution.
It's the hangover from the M&A party. They issued so many shares to buy all those breweries and other companies that the slice of the pie for existing shareholders got microscopic.
That's it, exactly. They printed shares like the Fed prints money to fund all those deals. The reverse split was the cleanup, but it creates a stigma. It tells the market, we failed to maintain value organically, so now we have to engineer it with financial tricks.
So, mixed grades for management.
I'd say high marks for survival and strategy. I mean, the pair of dodge is brilliant, but lower marks for capital allocation and shareholder dilution. Irwin Simon has kept the ship afloat in a hurricane, but the passengers, the shareholders, have gotten completely soaked along the way.
Chapter 3, Financial Health. Chapter 3, Financial Health. Okay, we've talked about the story of the beer trucks, the Trojan horse, and the CEO. Now we need the cold shower. Let's look at the hard numbers, because stories don't pay the rent.
Get your towel ready. The numbers are. They are sobering.
Let's start with revenue. We said it grew 16x since 2019. That sounds incredible.
Optically, the revenue growth looks amazing. A 56.7% compound annual growth rate over 5 years. But as we've already noted, that's mostly bought revenue. It's inorganic. If you look at organic growth, just the businesses they owned last year compared to this year, it's stalling in many areas.
And profitability. This is where I get nervous every time I look at their statements.
This is the hard part. The company has never posted a full fiscal year of GAAP profit.
Never. In all these years, through all the mergers and acquisitions.
Never. In fiscal year 2025, the net margin was negative 251%.
Whoa.
Now, to be fair, a lot of that was non-cash write-downs, basically just accounting adjustments where they admit that assets they bought were worth less than they thought. But even in the most recent quarter, Q2 2026, the net margin was still negative 20.7%.
Wait, hold on. A negative 20% net margin. So for every dollar they bring in sales, they are losing 20 cents on a net basis.
Roughly, yes. That is a number that makes you want to close your laptop and just walk away.
And that leads us directly to free cash flow. Can you define that for the listener who might not be an accountant? What is that number really telling us?
Sure, free cash flow, or FCF, is the lifeblood of a business. It's the cash you have left over after you pay all your operating expenses and you pay for the capital expenditures, the new equipment, the brewery tank repairs, everything needed to keep the lights on. It's the money you can actually put in your pocket or use to pay back debt or buy back stock.
And Tilray's FCF. Let me guess.
Consistently negative. In FY 2025, it was negative $127.5 million. Over the last 12 months leading up to today, it's negative $68.4 million.
So they're burning cash. Lots of it.
Technically, yes. A business with negative free cash flow is, as the saying goes, burning the furniture to stay warm. You can only do that for so long. Eventually, you run out of chairs.
But, and this is the big but,
Mm-hmm.
here, they aren't going bankrupt tomorrow. I mean, looking at those margins and that cash burn, they should be dead. Why aren't they?
Because of the Fortress balance sheet. This is their saving grace. This is the one thing they've managed incredibly well. Despite the losses, their balance sheet is very strong.
Okay, so how much cash do they have on hand?
As of the last report, they have $291.6 million in cash and marketable securities.
That's a decent runway. That buys a lot of furniture.
It does. It buys them a couple of years at the current burn rate, which is more than most of their competitors have, and their debt is very low. The debt-to-equity ratio is 0.19.
And for context, what's a normal or bad number there?
Anything over 1.0 is considered leveraged. Over 2.0 is getting dangerous, so 0.19 is incredibly low for a company of this size. They actually just paid down $100 million in debt recently.
That goes back to Irwin Simon's philosophy. I have a quote here from him. Debt is debt, and it can be death too.
He's absolutely right. In a high interest rate world, and remember, the 10-year treasury is at 4% in 2026, debt is expensive. If you are highly leveraged, the bank owns you. By having low debt, Tilray ensures that the bank doesn't own them. They control their own destiny.
So we have this weird situation. A company with no earnings, burning cash, but with a good cash reserve. How in the world do you value that? This is our educational moment. How do we put a price tag on a money-losing machine?
It's tricky. You can't use a price-to-earnings ratio, a PE ratio, because there are no earnings. So the first thing you look at is price to sales. Currently, it's trading at 1.04 times sales.
Is that high or low?
Historically, it's rock bottom. I mean, back in the bubble of 2018, it traded at 300 times sales.
300, that's insane.
It was pure insanity. Even compared to the broader beverage industry today, 1.04 is very cheap. You are essentially paying $1 for every dollar of revenue they generate.
And what about the discounted cash flow? We mentioned this in the intro. How does that work when the cash flow is negative?
Right. A discounted cash flow, or DCF, tries to predict all the future cash the company will generate for the next 10 years, and then discounts it back to what that money is worth today. For a company like this, you have to assume they eventually become cash flow positive.
So it's based on an assumption.
It's entirely based on assumptions about future margins and growth, and that's why the model gives us such a wide range of outcomes.
Okay, so give us the range. What's the worst case scenario?
The bear case? If margins don't improve and they just keep burning cash until they run out, the model spits out a value of $1.83. That's a long, painful way down from $7.80. If you believe the bear case, you short this stock immediately.
That is. Yeah, that's painful. Okay, what's the middle of the road case?
The base case? If they just stabilize, stop the bleeding, get to break even, and start growing modestly with the beer business and maybe some regulatory wins, the model gives us a value of $9.65.
So that suggests the stock is undervalued by about 22% right now.
Correct. The math, in the most probable scenario, suggests there is upside. It's not a moonshot, but it's a classic value play.
It's a bet on the turnaround.
Exactly. It's a probability game. You are betting that Irwin Simon can stop the bleeding before the cash runs out.
Part 2. Chapters 4 to 7. Market sentiment, ownership, risk, and final conclusion. Chapter 4. Market sentiment. Chapter 4. Market sentiment. Okay, we've looked at the company inside out. Now let's look at how the world sees it. Because at the end of the day, the stock price is determined by buyers and sellers, not just our spreadsheets. What is Wall Street saying?
Wall Street is, well, they're waiting. They're sitting on the sidelines. The consensus rating is basically a hold or a mild buy. They want to see Project 420 prove it actually works and that the cost savings stick.
They've been burned before.
They've been burned many, many times by cannabis promises. They want to see the proof.
But the price targets are interesting because they don't seem to match that hold rating.
They are. The average price target from analysts is $11.38. From our current price of $7.51, that's a potential upside of over 50%.
That's significant. That's not just a rounding error. That implies a strong conviction, even if the official rating is cautious.
The range is wide, though. The bears on Wall Street have it at $9.25, and the bulls are way up at $22. But here's the key takeaway. Even the lowest analyst target on the board is higher than the current price.
So nobody thinks it should be trading this low.
Not a single one. That tells you the institutional analysts all think the sell-off has gone too far. They believe the market is being overly pessimistic right now.
What's the news cycle been like lately? Has it been helping or hurting?
A total roller coaster. January 2026 was rough. They missed on earnings and the stock sold off hard. But then February hit and we got the Carlsberg deal we talked about.
And that changed things.
That shifted the sentiment right back to neutral, maybe even slightly positive. It gave people a tangible reason to believe in the CPG strategy again. It wasn't just talk anymore.
Let's talk about the shorts. I feel like Tilray has always been a battleground stock for short sellers.
It has. It's a magnet for them. Currently, the short interest is 13.71% of the float.
That feels high. I mean, more than 1 in 10 shares are actively being bet against.
It is high, but it's not astronomical for this sector. The peer average in cannabis is around 16%, so it's actually slightly less hated than its competitors, believe it or not. But 13% is definitely enough to create a squeeze.
Right. The days to cover is around 6.4, isn't it? Explain what that means.
Yes. That means if every single short seller wanted to buy back their shares to close their position, it would take 6.5 days of normal trading volume to absorb all that buying. So if good news hits like a surprise DEA announcement, that frantic rush for the exit could cause the price to spike very, very quickly.
So a squeeze is possible. But looking at the charts, the pure technical analysis, it's not looking pretty right now, is it?
No, the chart is ugly. Momentum is negative. The stock is trading well below its 50-day moving average, which is at 913, and way below its 200-day average, which is at 1099. It's in a clear downtrend.
And what does that mean to a trader or an investor looking at it today?
It means the trend is not your friend. The market has capitulated, but, and here's the contrarian view, for a value investor, you often want to buy when the chart looks terrible. You want to buy that capitulation. As the saying goes, the time to buy is when there is blood in the streets.
Even if the blood is coming from your own portfolio.
Especially then, that's when the assets are at their cheapest.
Chapter 5. Ownership structure. Chapter 5. Ownership structure. Okay, who actually owns this company? Because this tells a huge part of the story. This isn't just about who signs the checks. It's about who controls the volatility in the narrative.
This is, to me, the most unique and probably riskiest part of Tilray. It is owned by the people. Individual retail investors own 87.7% of the available float.
Almost 90% retail. That is wild. That sounds more like a meme stock than a multi-billion-dollar CPG company.
It is exceptionally high. Compare that to a mature company like Apple or Microsoft, which are, 80 or 90% owned by institutions, pension funds, BlackRock, Vanguard, the so-called smart money. Tilray is the complete opposite. It's owned by individual traders, by people on Reddit, by the retail army.
What does that imply for the stock's behavior?
It implies massive, gut-wrenching volatility. Retail investors trade on sentiment. They trade on narratives, on panic, on euphoria. They don't always trade on spreadsheets and DCF models. It means the stock price can disconnect from fundamental reality very, very quickly in both directions. It's driven by emotional capital, not just financial capital.
So where did all the institutions go? Were they ever involved?
Oh, they were. But they largely fled. Institutional ownership dropped by about 40% in the months leading up to that reverse split.
We saw it coming.
The smart money saw the writing on the wall about the dilution, and they just bailed. They didn't want to stick around for the cleanup.
So who is left from the institutional side?
Mostly passive ETFs. The big cannabis ETFs like YOLO or MJ. And they hold it because they have to hold it to match their index, not because an active portfolio manager picked it and said, I love this company and its fundamentals. It's forced ownership.
What about the insiders? Does Irvin Simon have skin in the game? Because if I'm betting on him to turn this ship around, I want to know he's in the boat with me.
He does, but maybe not as much as you'd hope for. Irvin Simon owns about 482,000 shares. At today's price, that's roughly $3.6 million.
Now, that's a lot of money to me. I'd take it.
It's a lot of money to anyone, no question. But in terms of percentage of the company, Total insider ownership is less than 1%.
That's low. Very low.
It is. This isn't an owner-operator structure where the founder has their entire life savings and 20% of the company on the line. It's a professional management team. They are paid handsome salaries and bonuses. Their alignment is there, but it's not the same as a founder-led business where the CEO eats what they kill right alongside the shareholders.
Chapter 6. Risk assessment. Chapter 6. Risk assessment. All right, we have to look at what could go wrong. We've painted this picture of a clever survival strategy, but there are landmines everywhere. And in this industry, the biggest villain isn't a competitor. It's a piece of the U.S. tax code.
Section 280E. It sounds incredibly boring, but it is the grim reaper of the entire cannabis industry.
Explain this to us. Why is 280E the enemy?
Section 280E is a strange relic of the war on drugs from back in the 1980s. Because cannabis is a Schedule I drug in the same category as heroin, the U.S. federal tax code says that any business that traffics in it cannot deduct normal, ordinary business expenses.
Wait, so you're telling me a cannabis company can't deduct things like rent? Or payroll?
Or marketing. Correct. None of it. Imagine you run a burger joint. You sell a burger for $5. It costs you $2 for the meat and the bun, and another $2 for your staff's wages and the rent on your store. You made $1 in profit. You pay tax on that $1.
Right. Seems fair.
Now, under 280E, the government says, we don't care about your staff or your rent. You pay tax on the $3 of gross profit between the sale price and the cost of the meat.
But I only made $1 in actual profit.
Exactly. And your tax bill on that $3 might be $1.50. So you actually lost money by selling a profitable burger. That is the insane reality of the cannabis industry in the U.S. Effective tax rates can hit 70%, 80%, or even higher.
That explains why nobody makes any money. It's structurally impossible. The game is rigged from the start.
It is the main structural blocker to profitability. You are running a marathon with a 50-pound weight vest on.
So the catalyst, the single event everyone is waiting for, is the DEA.
It's all about rescheduling. If the DEA moves cannabis from Schedule 1 to Schedule 3, alongside things like Tylenol with codeine, then Section 280E vanishes for state legal businesses.
Just like that. It's gone.
Just like that, overnight. Suddenly, Tilray and every other cannabis operator can deduct all their expenses. Their cash flow would explode. It is the single biggest what if in this entire analysis.
But if it stalls, if the bureaucracy drags its feet for another few years.
If it stalls, the cash burn continues, and that's the primary risk here. You are betting on politicians and bureaucrats in Washington, and betting on Washington to do the sensible thing quickly is usually a losing bet.
Okay, what about the more mundane market risks? We mentioned the Canadian market earlier.
Canada is just a tough, tough market. The price compression is real. There's way too much weed. The prices keep dropping. And the black market in Canada is still thriving, which puts a hard ceiling on what legal companies can charge. If the legal weed is too expensive, people just call their guy.
And then there's the risk in their big new bet, alcohol. We said they're pivoting to beer, but isn't Gen Z drinking less beer? I keep hearing about California sober and kids just not being into alcohol. They are, and that is the cannibalization risk. Tilray is buying beer brands at a time when the overall beer market is shrinking. Younger people are drinking spirits or hard seltzers, or they're just using cannabis instead of alcohol.
So Tilray is betting they can buck that trend by focusing on premium craft beer.
Right. They are betting on craft beer, which is holding up a little better than mass market beer like Bud Light. And of course, the big bet is that eventually those beer cans will hold THC, not alcohol. They are hedging their bets, but it's still a risk.
One last risk factor, the macro environment. The big picture.
Inflation and interest rates. Inflation is sticky. It's hanging around 2.7%.
Yeah.
That hurts discretionary spending. If people are struggling to afford eggs and gas, they might buy less $12 craft beer or premium pre-rolls.
And the rates. And interest rates, with the 10-year Treasury at 4%, mean that growth stocks are less attractive. An investor can get a guaranteed 4% return from a government bond. Why risk your money on a volatile, money-losing stock like Tilray unless the potential return is massive? It raises the bar for what an acceptable return is.
Chapter 7. Conclusion. Chapter 7. Conclusion. Okay, we have unpacked the business, the management, the hard numbers, the market sentiment, and all the risks. We've gone deep on the beer trucks, the taxes, the tariffs, and the reverse split. Let's bring it all together.
Right. We need to synthesize all this into a clear bear case and a clear bull case.
Give me the bear case first. Lay it on me. Why should I run away from this stock and never look back?
The bear case is that Tilray is a cash-burning machine that's being masked by a constant stream of M&A. The reverse split proved that dilution is the real story here. They are financing the company by printing shares and shrinking your ownership. The core cannabis business is unprofitable because of taxes and competition. The beer brands they bought are in a shrinking industry. If the U.S. doesn't legalize or reschedule soon, the whole business model fails. And in that world, the intrinsic value is $1.83.
That is a grim picture, a total value trap. Okay, now, give me the bull case. Why should I be excited to buy this price?
The bull case is that Tilray is a survivalist fortress. They have the cash, $291 million, to outlast everyone else in this brutal industry. The beer distribution network is a dormant superpower, a Trojan horse waiting to be unlocked for cannabis. The Carlsberg deal proves they are a serious CPG player, not a pot stock. And crucially, in 2026, they are immune to the 25% tariffs, which gives them a massive hidden competitive advantage. If the DEA reschedules, this stock isn't a $7 stock. Our model says it could be worth $16.17 or even more.
So what is the final verdict, the middle ground? Where do we land?
The base case intrinsic value from our model is $9.65. The current price is hovering around $7.51.
So there's a margin of safety, as Benjamin Graham would say.
There is. You are buying it at a roughly 22% discount to what our model says is its fair value. But, and I cannot stress this enough, it is not a safe compounder. This is not Coca-Cola. It is a turnaround special situation. It requires a very strong stomach for volatility.
It's not for the faint of heart.
Definitely not. You will have sleepless nights owning this stock. But for the investor who believes in the eventual normalization of cannabis and wants a company that actually has the physical infrastructure to win when that happens, Tilray is arguably the best positioned player on the entire board.
Here is a final provocative thought for you to take with you. We talk about alcohol versus cannabis as if they're in a death match. But consider this. If the future of socializing isn't a pint of lager, but a functional beverage, maybe something with a little THC to relax you or something with adaptogens to help you focus, does it really matter what's in the can? Or does it matter who owns the pipes and the trucks that get that can to your doorstep? Tilray is betting that they own the pipes. And if they're right, they might just own the future of the party.
That is the billion-dollar question right there.
That wraps up our deep dive into Tilray Brands.
This analysis was generated by AI for educational purposes and should not be considered financial advice. Please do your own research before making investment decisions.
Thanks for listening. We'll see you on the next deep dive.